Investment markets have had a strong start to 2012 as many asset classes have made strong gains. Investors are favouring assets that are exposed to the global economy and that are considered to have a higher level of risk associated with them. Within the equity markets, cyclical sectors have outperformed for the first time since the sell-off in August 2011. Likewise, in commodities, the industrial sector, which had suffered in the second half of 2011, also made notable gains. In bond markets, Spain, Italy and France and Ireland all made strong gains. However, in contrast to previous risk-on trades, German bond yields have remained unchanged, implying that investors are continuing to hold safer asset classes as well. Overall, sentiment has improved greatly since December, and the risks that were being priced into markets in November have waned, such as the risk of a banking crisis in Europe or even possibly the breakup of the euro. The ECB's decision to loosen central bank policy and provide unlimited liquidity to the banking sector for 3 years in December has been a great boost to confidence. They are going to provide a second auction in November. This liquidity is flowing into the banking sector and has removed the risk of a bank failure. Also, the liquidity is flowing into government bond markets as the yields in Spain, France, Italy and even Ireland have moved back to a more sustainable level, allowing countries to refinance themselves easier. Elsewhere, EU leaders have continued their commitment to closer fiscal union. Economic data in the Eurozone has also stabilised, implying that the recession there will not be as bad or as long as had been thought in the second half of 2011. Economic data in China has also come in better than expected, while in the US the economic recovery has continued to improve and is now quite evident in the labour market. The sharp increases that have been evident in equity markets are unlikely to continue at the same pace, although the positive momentum is expected to continue until at least the end of February, when the ECB gives the banking system an additional round of liquidity. This extra liquidity is likely to drive markets until then. The ongoing negotiations with Greece, however, poses an additional risk to markets, as well as any potential disappointment in data on the economic front, either in Europe or in the US, could also be a risk when sentiment is this positive.